Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. Great to be back. Great to see everyone back. All the viewers, all the subscribers. Immensely appreciate all the support on the portfolio. For today's video, I want to do part 2 of the options series I started yesterday. Yesterday I talked about covered calls. Let's switch it up and now talk about covered puts. Kind of the opposite of a covered call. Just like covered calls, very easy to understand, very intuitive, very easy to get into a trade. And that's what I've been using on the portfolio. Puts and calls, selling both of those off to make good weekly income. And you guys can see those weeks of income on the portfolio, on the channel. Just scroll through. I do an update of those every week. If we scroll down here, you can see all of the current options contracts that I have for Friday, 9/17, and then one on the bottom there for 9/24 as well. Before we do that, let's talk about the portfolio. Very strong performance today of 16,898, just over 718,000 now for the portfolio. So rebounding quite nicely here. It has been dropping over the past couple months, so nice to see a nice strong day in the green. And this is the contract we'll be talking about today. Tesla 665 put. This essentially means if the price of the stock gets below 665, I'll have to buy it at that price. You can see current price, bottom left-hand corner, 755. So highly unlikely that's going to execute. But let's go ahead and take a look at Tesla here. And let's do a sample trade here, hypothetical trade, to show you guys exactly what we're doing here. So we can go trade options. In the middle there, you can see sell a covered put. This is what we'll be doing today. Just briefly here, it gives you the obligation to buy 100 shares, one contract of stock at the strike price, basically the share price that you will be willing to buy the stock for by the expiration date. You'll earn a premium income to the portfolio, but might be obligated to buy the shares for unfavorable price. If we click on learn more there, more details here. Again, this is very easy to understand. If you do a couple of these are very easy to get into. Up on the top there, again, some terms. The strike price is what you'll be willing to buy the stock for at a set date. That's when the contract essentially expires. If the stock does not get under your strike price, nothing happens to keep the premium. And then to do this, it's a covered put, meaning you have to have cash in your portfolio before you enter into the contract. So cash covered there, as you can see. You have to have this portfolio funded, or your portfolio funded, before you can do a cash secured put. And you have to have enough money to buy the stock, 100 shares of it, at whatever price you put in for the strike price. And some more terms in the middle there. In the money, at the money, out of the money. At the money is when the stock price is at the strike price. That rarely happens. In the money is the stock price is below your strike price. So it falls below your strike price. You have to buy the stock at a higher price than what it would be worth at that point. And what I do is out of the money contracts, the stock price is above the strike price. Let's take a look at a contract here. Let's go back. And let's go over to a few of these contracts. You can see up on the top there, different expiration dates, September 17th, 24th, some in October here. Up on top here, let's go sell and then put. So this is what we're doing here, selling a put off. You can see the current price in the middle, 755.65. You can see some strike prices on the left there, 760, 765, 770, 755, 750, 745. So those are all the potential strike prices you can do. Again, if the strike price is the same as the share price, which is really hard to do. It's almost never in that particular situation. That would be at the money. So if the price of the stock is above that share price, that would be in the money. So let's say it's 770, for example. 755 is where the price is. You'd still have to buy the stock at 770 if you entered into a contract, because the strike price 770 is now above the share price. What I do is out of the money. So I'd pick something that's way below that share price of 755. So let's do an example here. Let's go down and pick, for example, 720. So unless the stock gets below 720, nothing happens. I keep the premium of $1,020 for this particular trade. Let's take a look at the graphics here. So you can see the current share price, 755.20. The stock would have to drop all the way down here to 720 before it executes. And if you factor in the premium I receive as well, it would have to fall all the way down to if I can get it over here and stay there, 709.80 before I start losing money. So even if I bought the stock here with the premium, it would still be okay. I wouldn't be technically in the red. So that is what we're doing here. So if the stock doesn't drop to this point here, 720, nothing happens. I keep the premium, the contract disappears. If it is dropping to this range here, I have to buy the stock, but I could immediately sell it off and still make a positive trade because of the options that I got, the premium that I got. But it starts getting below this point at this point, 709.80. This is when I start losing money. So you can see here, if you put the strike price in way down here, for example, it's very unlikely that the price of the stock will drop that low. So they're very, again, easily understood here. I think you guys can follow this along. And they're very, very powerful. This is what I've been doing on the portfolio. Doing put contracts to get into a position, and then call contracts to sell off the position. And let's take a look at Tesla here, just to give you an example of the income. But again, take a look at the video series. I have a whole series of videos on all the income I receive each week on my options contracts. But let's go down. History, show all. And you'll see all of the income I'm receiving. And we'll go down and show you one swing trade as well. So here, some put contracts, 520, 2,205, scrolling down 400, 203, 765, 350, 440, 605, 152, 320. Let's see if we can't find one that executed here. Here we go. A Tesla 655 call. Again, from that prior video, that means I sold off at 655. If we scroll down further here, some more contracts, 725, 810, 510. You'll see the contract here, the put contract, in which also executed. So I had to buy the stock at 645 and 655, but then I sold off, or excuse me, 645 and 650 down here on the bottom. And then I sold off up here at 655. So not only did I make money on the put contract, I made money on the call contract, the call assignment here, and also the swing trades, buying at 645 and 650 and selling off at 655. So that's how I've been making a lot of money on the portfolio. So those are cash covered puts. I hope that made sense to you guys. That's how I've been making money on the portfolio, getting into positions with the put contract, selling that off, and then getting out of position with the call contract when I sell off, and then hopefully a positive swing trade as well. So just wanted to quickly go through that, part 2 of the option series, covered puts. Again, I'll be putting out a video either Thursday or Friday discussing the income on the portfolio with regards to options. Again, quite a few that are pending for Friday and one that is pending for next week as well. And my goal is to make $4,000 per week at this point. If I can maintain that, that's about $200,000 or so of income per year, and that'd be a very good return on the portfolio. That's my goal moving forward. But not to make the video too long, I'll kind of end it here. Again, if you guys enjoy these types of videos, please let me know. If you guys enjoy the YouTube channel, please feel free to like, share, and subscribe. And until next video, we'll see you then.